It's been 20 years since the first REIT was listed on the Singapore Exchange in 2002. Since then, REITs have become a staple of portfolios for investors who are attracted to the dividends and generally low risk. In 2021, S-REITs generated a 6.2% total return, compared to the STI's total return of 13.6%. This followed a 2.2% decline in 2020 and a 27.5% total return in 2019. This brought the annualized total return of the iEdge S-REIT index over the past 3 years to 9.8%, doubling the STI annualized total return of 4.5%. In 2021, some S-REITs outperformed the STI. And market watchers looking ahead are optimistic.
We see the outlook for the sector brightening on the back of steady economic growth and with more easing of COVID measures anticipated as we progress into 2022. This should have a positive impact on the REIT's operational performance, with overall sector DPU growth expected to increase by about 5 to 15% in 2022.
Despite the worry about Omicron cases, the bigger concern is volatility from the impending rate hikes announced by the US Federal Reserve.
The key worry about this year is not Omicron, but rather I feel it's about rate hikes and inflation. In the near term, the general positioning among the investors would be a bit more cautious first, and there will probably be some share price weakness up on news flow about how Fed is thinking or how Fed is being a bit more hawkish than expected.
With half of office workers now able to return to workplaces, business areas are already seeing an uptick in footfall. However, market figures show that office demand and rentals did not drop by much, even during previous periods of heightened restrictions. So analysts expect similar resilience, even if working from home or a hybrid model becomes the norm.
We did an analysis. We just look at the whole of Singapore CBD. On average per year, type of leases that's coming up for renewal as a whole, even if, let's say, companies cut real estate footprints by, say, 30%, the return of space is going to be less than 600,000-700,000 square feet, and that is equal to 1 year's worth of demand. So I would say that things are quite stable. We will find that balance in the medium term, and I think that balance will be one that's anchored around workers still being in office.
The rise of co-working spaces has also added another layer of flexibility for companies who may not want all their workers to return to the traditional office.
Another model that is evolving in the office sector is a hub and spoke model, where employees are able to work somewhere closer to their home instead of going or traveling a long distance to their office place. Additionally, there are still a lot of employers who are still a bit uncertain at this moment about how many people would be still working in the office space at this point of time, or what kind of timeline we are looking for the complete return to office. So these players are also tapping into the co-working sector.
On the supply side, manpower disruptions in the last 2 years due to the pandemic have caused delays in the completion of some new office buildings and redevelopment projects. This has also kept office demand tight, which is good news for REITs.
Moving on, we are likely to see landlords of tired buildings taking these buildings off the market for redevelopment or major retrofitting works. Now, come the next lease renewal cycle, starting in, say, 2025, if the work from home culture is annulled and office workers come rushing back to the CBD, given the dearth of supply of new office buildings, there could be a severe spatial crunch, and that could lead to skyrocketing office rents.
By sector, retail and office REITs were in negative territory in 2020, then reversed course in 2021. Despite the overall positive outlook, not all REITs are the same. Here are some of the experts' picks.
We advocate investors to focus more on the reopening play, so the mixed commercial REITs, retail, even in hospitality, even in industrial, we like those with logistics exposure, mainly for its growth momentum. Do not be afraid of corrections. In fact, be greedy when everybody's afraid.
Data centers will still be in demand, at least for the next few years, because of the heavy data load that technology is bringing about. And so that should be still something that's going to be favored.
We expect REITs, particularly some large cap REITs, as well as stocks with specific catalyst in sectors such as industrial, office, and retail and commercial to continue to outperform. The wild card would be the hospitality sector REITs. We believe that the hospitality recovery is only expected in 2023. So possibly in second half of 2022 could be a thing to watch out for hospitality sector REITs.